This morning, silver did something that instantly grabbed attention across global markets. In just a few hours, prices slid sharply from the upper end of the daily range, falling more than 2% and breaking below levels many traders thought would hold. On the screen, it looks simple. Silver at around $90 an ounce, down over $2 on the day. But behind that single number is a story most people completely misunderstand. Some see this move and panic, thinking the rally is over. Others rush in, convinced this is a perfect dip to buy. The truth is, neither reaction is based on understanding what is actually happening. Silver is not moving randomly, and it is not reacting to emotion alone. This kind of price action is the result of structure, liquidity, and how modern markets really work beneath the surface. When silver drops this fast, it forces everyone to ask the same question. Is this a warning sign, or is it just another test in a much larger trend? To make sense of today's move, we need to slow everything down and zoom out. That means understanding why the bid is falling faster than the ask, why the daily range between roughly $86 and $92 matters, and why silver behaves very differently from assets like stocks or even gold. It also means separating noise from signal. Short-term price charts can trigger fear, but they don't explain intent. In this video, we're not here to predict tomorrow's price or sell excitement. We're here to decode what today's silver numbers are actually telling us about market pressure, trader positioning, and risk. By the end, you'll understand why sharp moves like this happen, why they catch so many people off guard, and how to look at silver with clarity instead of emotion, even on days when the price suddenly turns red. The first thing to understand about today's move in silver is that a drop of 2% at these price levels is not a small event, but it is also not automatically a crash. When silver is trading near $90 an ounce, every single dollar represents a large amount of capital changing hands. A move from around 92 down toward 90 is enough to trigger stop losses, margin calls, and algorithmic selling, especially in highly leveraged paper markets. This is why the price can appear to fall suddenly, even when there is no single piece of breaking news behind it. What you are seeing is a liquidity event, not panic in the traditional sense. As bids get pulled and sellers become more aggressive, price moves quickly to the next level where buyers are willing to step in. Another key detail is the day's range. When silver trades between roughly $86 and $92 in the same session, it tells us volatility is expanding. Expanding volatility usually means the market is searching for balance. Strong hands are testing weak hands, and weak hands are being forced out. This process is uncomfortable to watch, but it is how markets reset after fast rallies. Many people assume that if silver is down on the day, demand must be disappearing. In reality, demand does not vanish overnight. What changes is the price at which buyers are willing to commit capital. Understanding this difference is critical because it prevents emotional decisions based on short-term price swings rather than real market structure. Now let's dive deeper into why silver is moving like this today. One major factor is the interplay between physical demand and paper markets. Silver isn't just a commodity, it's also a financial instrument, which means traders in futures, ETFs, and other derivatives can create massive moves without ever touching a single ounce of the metal. When you see silver gap down a few dollars, much of that is driven by paper positions being unwound, margin calls being triggered, and algorithmic trading reacting to short-term price signals. Meanwhile, physical demand from industrial buyers, jewelry makers, and bullion investors remains relatively steady. This creates a disconnect where the price on your screen may drop sharply, yet actual physical silver is still being bought and held. For anyone invested in silver for the long term, recognizing this distinction is critical. Selling because the chart looks scary could mean exiting just as strong hands are accumulating. Understanding that the market has two layers, paper and physical, helps you see why swings like today's can be both dramatic and temporary. It's a reminder that volatility is part of silver's DNA, and that markets often overreact before finding equilibrium again. Another key aspect driving today's silver price movement is global macroeconomic uncertainty. Inflation fears, interest rate expectations, and the strength of the US dollar all play a crucial role in shaping investor sentiment. When the dollar strengthens, silver and other precious metals often feel downward pressure because they become more expensive for holders of other currencies. Conversely, when inflation concerns rise, investors flock to silver as a hedge, pushing prices higher. Right now, we are seeing a tug of war between these forces. Central banks signaling tighter monetary policies versus geopolitical tensions and supply chain concerns keeping safe haven demand elevated. Add to this the rumors and speculation swirling around major banks and institutional positions, and you get a perfect storm of volatility. Traders and investors must recognize that these price swings are not just random. They are the result of a complex mix of currency flows, interest rate expectations, and large-scale institutional maneuvers. For the everyday investor, this means it is crucial to separate noise from the bigger picture. Silver, S long term fundamentals, remain strong even if short term charts look chaotic. Being patient and informed is the key to navigating these turbulent days. Another important factor to consider is the role of industrial demand in today's silver market. Unlike gold, silver has extensive industrial applications, from electronics and solar panels to medical equipment and batteries. As the global economy continues to push toward renewable energy and high tech manufacturing, silver's industrial demand is steadily increasing, creating a baseline of support for prices even amid short term volatility. This means that every dip in price could be met with buying interest from both investors and industries needing physical silver for production. On the flip side, any sudden news about economic slowdowns or reduced manufacturing activity can trigger sharp drops, as we've seen in recent days. Understanding this dual nature of silver, both as an investment asset and an industrial commodity, is essential for anyone tracking price movements. It also explains why silver can experience rapid spikes and equally fast pullbacks, sometimes within the same trading session. By following global production trends, inventory levels, and technological adoption rates, investors can anticipate longer-term price support even when short-term charts appear unstable. Essentially, silver is not just a speculative asset. It's a critical raw material whose value is intertwined with the world economy. Another critical aspect driving today's silver price action is the influence of market speculation and trading psychology. When traders see prices rising rapidly, FOMO, or fear of missing out, kicks in, prompting many retail investors to buy at or near recent highs. This buying frenzy can push silver prices even higher in a short span, but it also creates vulnerability. As soon as a few large traders or institutions decide to take profits or sell into the market, the price can drop just as quickly, triggering panic selling among smaller investors. This dynamic creates what's known as a whipsaw effect, where silver can swing dramatically within hours. Adding to the volatility is the growing influence of algorithmic and high-frequency trading. These systems react instantly to price moves, news, and even social media mentions, often magnifying short-term fluctuations. Understanding this behavior is crucial because it explains why silver prices sometimes appear disconnected from fundamental factors like industrial demand or geopolitical events. It also highlights why timing and patience matter. Short-term traders must be cautious not to get trapped in these fast swings, while long-term investors should focus on broader trends and the underlying value of silver as both an industrial metal and a store of wealth. In conclusion, the silver market today is a complex mix of fundamental value, industrial demand, and intense market psychology. Prices are swinging rapidly due to a combination of investor sentiment, institutional actions, and algorithm-driven trading, making short-term moves unpredictable. For those watching this market, the key takeaway is to stay informed, remain patient, and separate emotion from strategy. Long-term investors can benefit from understanding Silver's historical role as a store of value and industrial necessity, while traders need to respect the volatility and manage risk carefully. Silver will continue to offer opportunities, but success depends on knowledge, timing, and disciplined decision-making.
Hello friend, welcome to my YouTube channel. I hope all if you are doing great and having an amazing day. My name is Noor Baqi and I am really excited to start this new journey with all if you. You know this channel is not just about videos, it is about story and ideas and inspiration. I created this channel to sharing something positive every signal week. Sometimes we all need little motivation, and sometimes we just need a good story to smile again. Decide exactly what this channel is all about. You find understanding stories, real life experience, and powerful lessons that again change the way you think. I be uploading new videos regularly. So if you don't want to miss any of them, make sure to subscribe to my YouTube channel and press this bell icon so you get notification whenever you post something new. You support means everything to me, and to great we can build a community full of fraternity, learning, and good vibes. So sit back, relax, and let us begin this amazing journey together. Thank you so much for watching and welcome once again.